take advantage of it. And over time, commodity margins tend to migrate back towards zero. Now, in the short term, we do get opportunities, and again, we need to take advantage of those because, you know, when prices are high, what do? We increase acres. When prices are low, we usually cut back, and ultimately prices come back up, margins come back up. Commodities don't care what your expenses are. I've had several people at meetings say, don't they know what it costs to grow corn? Number one, I don't know who they is. Number two, no. You know, commodities are basically supply-demand businesses, and that's going to determine where price goes. Now, over time, yes, you know, if it starts to cost way too much money to grow a corn crop, you know, we're going to cut back on acres and we'll reduce it. But in the short term, you know, we're really just looking at supply-demand as the market features. And then lastly, commodities tend to be good hedges for inflation. This has happened over the last 2-3 years. We've seen a lot of inflationary pressure in markets, and you've seen a lot of investment cash come into the commodity markets as a hedge for that inflation. And if you take a look at the Goldman Sachs Commodity Index, this is an index that's made up of about 30 different commodities. It's not just ag, but we do have the grains, we do have livestock in here, but we also have energy markets like oil, natural gas. You've got precious metals in here. You've got soft commodities like cotton, lumber, cocoa, coffee. Those all make up this index. Oil tends to be maybe the biggest piece of this, but you can see what commodities have done over the last several years. And you know, you go back to 2008, you had a high in this commodity index. And what happened in the fall of 08 that stopped the market? We had the housing bubble burst, and everything kind of went to hell. And people sold stocks, they sold commodities, everybody dumped everything. By early 09, we had taken this commodity index back down to a new low again. Then we kind of moved back higher, 2011, 12, 13. Had another good run in commodity prices. A lot of that was driven by ag. We had record high in wheat, I think in 2011. You had in 12, of course, we had the drought, which took corn and beans to record high levels as well. And that kind of helped lift the index, and for 2 or 3 years we had some good commodity prices. But what happened out into 14, some of that dip was driven by ag. Because what happened with record high prices in 12? We increased acres, we decreased demand, and prices ended up falling in 14. And you can see for several years we saw some fairly low commodity levels. 2020 was the COVID low when everybody dumped everything. But coming out of COVID, you know, really the first markets that started to move were commodities, and those were food and fuel markets. Because everybody figured once the economy reopens, we're going to have to eat, we're going to have to be able to move around and heat our homes and such. So the commodity market started to rally. Then we got into some inflationary years. We started going 7, 8, 9% inflation, 40-year highs in inflation. And when that started happening, you had a lot of investment cash start to go into the commodity markets. You know, you think about it from a hedge fund manager. Would you rather buy corn, wheat, soybeans, or would you rather buy Carnival Cruise Line stock? You know, nobody wanted to buy cruise line stock or some of these other stocks following COVID. So a lot of that cash started pumping up the commodity markets. And for 2 years, you saw a nice run in commodities. Then last spring, we had the outbreak of the Ukraine war, which took it up another notch. You saw a lot of buying come into wheat, corn, the energy markets due to the pipeline being shut down, and that took this index to the highest level it had been since back in 2008. Now, the last few months seem kind of a settling down a little bit. We've talked a lot about the R word, recession, and what happens in a recession. We typically see a slowdown in manufacturing and other things that would require commodities. And so you started seeing some selling in several of those different markets. Lumber is probably the biggest one that's easy to see. You look at the lumber chart, you go back to 2020 at COVID, when the low was made, everybody kind of dumped lumber. But what was one of the big markets, one of the big rallies we had in 21, 22 was lumber. Went to record high prices, and now the lumber market's crashed and burned again. So again, based on recessionary talk. So that kind of takes us into 2023. You know, we're still sitting in the top probably third of commodity prices over the last 15 years. Question is, where do we go from here? What's this this hedge fund money going to do? Is it going to stick around in commodities? Is it going to go somewhere else? You know, you think about some of the alternative investments that a trader would have. You can put money on interest now. You can go make 4.5% interest on a CD, which you couldn't do a year ago. So there are some alternatives from an investment standpoint that we didn't have back then. Now, this is a snapshot of what happened in the month of January, which markets were winners and which ones were losers. Generally, you know, we had probably a couple more losers than winners. The biggest loser was natural gas. You had, and you look back to going into winter, and I was maybe a little bit guilty of this, thinking, boy, if we get a cold winter this year, especially in Europe, this fuel market could just go berserk. Europe's had one of the warmest winters it's had in several years. And so everybody was loaded up on supply. Market didn't, you know, we didn't have the cold winter so far. And so you've seen some huge selling in the natural gas market. Some of the other energy markets down as well, ethanol, heating oil, etc. The big winner was coffee, but zinc, copper, aluminum, some of the precious metals have done very well starting out the year this year. By the way, beans 0.9%, corn 0.2%. So basically almost unchanged in the month of January. So looking back at just ag, this is a snapshot of what these funds have done in the corn, wheat, and soybean markets over the last 7 years. The black line shows what they did in 2022. And if you go back to last winter at this time, these funds were long about 600,000 contracts in the grain markets. When the war broke out, they bought. In fact, they built their position to a record, over 800,000 contracts by the beginning of May. But what often happens in the U.S., if and when we get the crop in the ground and it gets a good start to it, a lot of these funds sell. You know, they get ahead of this thing. They don't wait till the 4th of July anymore to start dumping. They start selling early. And you saw that happen last year with the prospects of a big crop, big acres. Funds started liquidating, took their position down by the end of July, down to 300,000 contracts. Probably a little bit too quick because we got into a late summer drought. Especially out in the Central Plains, Western Corn Belt, and that started to take the top off the yields, both corn and soybeans, and these funds came back into market and bought back part of what they had sold. Now, the last several weeks, you've seen some net selling, especially in the corn market, wheat market as well, with some disappointing export numbers that we've seen. And so this takes us to the beginning of the year. You know, these funds are kind of in no man's land right now with their position. The previous 2 years at year end, they were holding at or near or at record long positions because we had tight stocks of all these crops, we had good demand still, and we needed to incent acreage. The previous 4 years, when we had huge stocks built up, these funds were actually even to short those markets at year end. Right now, we're just kind of in the middle. And so I think this year could maybe be a transition year for these markets. What kind of crops do we have this year? If we're going to grow big acres, both in South America and in North America, you know, will we build stocks back up to some big numbers? And I think that's what there's a lot of certainly concern about here heading into this year. So we're mostly focused on return. What are we going to be able to make this year? What kind of profitability are we looking at? And this is something that Farm Doc just put out recently, looking at corn profitability. And you know, you can see going back to 2000, you know, margins are pretty slim. We did get a good run of years from about 04 to 2012, where we had some good profitability in corn production. But then what happened in 2013? You know, we talked about that earlier. Following $8 corn, we chopped demand and we increased acres. And at the same time, we increased input costs. A lot of inputs went up following that 12 rally. And so margins slammed down. And by 13 and on over the next several years, you saw at or negative margin opportunities in corn. Now, the last couple of years, we've had a good bounce back again. Give kudos to these funds for buying and rallying this corn market. We've had corn prices back up to the highest they've been in 10 years. Couple that with a handful of government program payments sprinkled in, you know, we've had some good profitability the last couple of years. Now, Farm Doc, they're projecting a big drop this coming year. Purdue put out some numbers a month ago, forecasting a drop in profitability. CoBank had a report 2 weeks ago, forecasting a big drop this year. And I think everybody's thinking, of course, inputs are up a little bit. They're thinking that acres are going to be up, but also that prices are probably going to drop this year. And so based on kind of the same scenario we had following 2012. And we'll look at prices here in a minute, but I think we were kind of set up for this past year. Had we not run into that drought late in the summer, you know, we were talking about 180 bushel corn back in July as a national average, and if that would have happened, you know, you'd have had some big stock numbers. So we'll see what happens. Now, I don't think we're there right now, because if you look at, these are the crop insurance prices over the last 16 years in gold, and we started setting these prices yesterday for this year. The blue line is this last night's close at $5.96. Right now we're 6 cents higher than last year. So I don't think this jives with what Farm Doc and some of the others are saying. Now that doesn't mean throughout the year that we're not going to go down, but it means that we're starting out with some good opportunity here in the corn market. So that's what we're going to be looking at with crop insurance, certainly from a marketing perspective as well, trying to get some of this stuff locked in. If we start here at $5.96, it'll be the second highest year we've ever had. So feeling pretty good about that. Soybeans, down at the bottom of the chart, you can see the profitability on beans as well. You know, they're expecting numbers to drop almost in half this coming year, but prices still holding fairly good, down about 70 cents from last year, but still the second highest year we've ever had. So I still think the opportunity right now is good to be locking in some stuff for this year. So market factors right now, besides the investment money we talked about, South American weather, certainly a big factor right now. It's kind of like August the 2nd down there, so pretty important time, especially for bean production. Black Sea grain exports, what's going to happen out of the Ukraine, both for old crop as well as this coming year. China, are they going to fully open the economy up? Are they going to start buying more that they haven't so far this year? U.S. acreage intentions, what are we going to plant to what this spring? And then more black swan events. And if you're not familiar with the black swan event, it's kind of one of those unforeseen events that kind of comes out of nowhere. We've had more black swan events in the last 3 years than we've had in a long time. You know, it really started with COVID, but then coming out of COVID, we talked about this a minute ago, you had inflation at 40-year highs. Then our government, trying to be wise, decides it's going to fix inflation by raising interest rates. So now you've got interest rates the highest they've been in several years. You had the Ukraine war last spring. Just a lot of weird stuff that's been happening in our marketplace. So hopefully we can go a while without one of those, knock on wood. So I want to start out looking at soybeans. The soybean market's certainly been the most volatile lately. These were the final state yield numbers from the January crop report about 3 weeks ago. Red states all went down, blue states went up from last year. Only North Dakota and Minnesota were higher because they had a drought the previous year and their yields stunk 2 years ago. So they did bounce back a little bit. The Illinois state yield was down 3.1% at 63 bushel an acre. Still nothing to sneeze about. The U.S. bean yield at 49.5 bushel was down 4.3% from last year. And in that report, USDA, in addition to cutting the yield, also took harvested acres down 300,000. Apparently we had some abandoned acres, probably out in Nebraska, Kansas, because of the drought this year. So production was down. Now what USDA often does is when they reduce production, they'll take demand down as well, so they don't change the bottom line numbers. They did drop export demand down below 2 billion bushels, still keeping ending stocks at 210 million bushels. I don't think those numbers are right. I think our export number is still going to be higher than this. I think ending stocks could be below 200 million. I don't think USDA wanted to publish a number that low this early. But I still think that we're a little tighter than that based on current demand. Now, we just had a weekly export sales report out this morning at 7:30. These were the numbers. Bean sales, and they've dropped back a little bit. They're down to 736 million metric tons last week, but we're still running 5% ahead of last year. And so something's not right. The government says we're going to be down 168. Sales year to date, about halfway through the year, are actually running 5% ahead of normal. So, and if you look at that, now this is a few weeks old now, but we're still running well ahead of last year, well ahead of the 5-year average. So I think there's a really good chance USDA is too low on its annual estimate. They're going to end up raising that number at some point in time. And the other big positive, I think, for beans going forward is going to be domestic demand. And that's not getting a lot of attention at the moment, but If you talk to anybody in the, working for a crushing facility, they're making a lot of money right now. Crushing margins are strong. We've got at least 18 crushing facilities in the U.S. that are either in the planning stage, in the building stage, or in expansion. So we're going to see big increase in domestic usage. You can see what's expected over the next 3 or 4 years, that domestic crush is going to continue to grow. I think this is a great positive for soybeans. That means we're going to be a lot less reliant upon China for bean exports, and we would all welcome that. Brazil's going to keep growing as well. We're pretty certain about that. They're going to continue to get a bigger and bigger slice of the Chinese export pie, but as long as we've got soy diesel demand for the oil, and we've got the livestock demand for the meal, certainly this is a big positive for the bean market. Now, right now, most of the focus is on South America. And if you look at Brazil so far this marketing year, they're off to a great start. They're starting to harvest beans in Mato Grosso. I think they're about 13% harvested as of Monday. So their cycle is moving right along. They planted 107 million acres of beans this year. That's a record. Expected to grow a crop of over 5.6 billion bushels, also a record. We've had a couple of estimates the last couple of days that have come in pretty similar to these numbers, so the numbers aren't falling at this point in time. So off to a good start, it looks like, for their crop year. Now, if you want to be bullish beans right now, focus on Argentina. They've had a drought for the 3rd straight year. Early on, they were forecasting 50 million ton production. USDA dropped their number to 45 million this last month. I think we had an attaché down there that came out at 39 with a number yesterday. Several in the market are talking maybe down into the 38 to 35 range. So that crop has gotten smaller. They've lost probably 25–30% off of what they were expecting. So it's kind of, you know, Brazil's bigger, Argentina down. And if you look at the weather right now, this is the latest vegetative health map we've gotten. I think we get these every 2 weeks when the satellite goes around the globe. But you can see most of Brazil's in really good shape this year, or at least average, which with big acres, that means they're going to have a big crop. But you get down into Uruguay, Paraguay, and especially into Argentina, that's where the struggle is. And so they've planted a lot of crop late, waiting on rains. Some of that late crop's going to do fairly well because they have gotten some rain lately. And from January 22nd to the 28th, you can see here that much of that dry part of Argentina has gotten some moisture at least. And so they've gotten a reprieve, and that's kind of what stopped the bean rally here about a week ago. Since then, we're getting mixed forecasts. We came in Monday talking about a drier forecast, and even this morning's 7-day map shows a big hole right there in Argentina, Uruguay, and up into Paraguay. The 2-week forecast does bring some rain into that area, but it's got some holes in it as well. So this is what the bean market's wrestling with right now on a daily basis. You know, what's going to happen down there? Are they going to be dry? Are they going to get rain? What's going to happen? It's kind of like Illinois in August. You know, it's a pretty important time for the bean market. So we'll continue to watch this pretty closely. We'll also watch up in Brazil. You know, if this really, really wet weather extends up into Mato Grosso, it's going to delay some of the harvest up there. Also, they plant 75% or raise 75% of their corn crop planted following soybeans. So a little bit odd, but that's what they do down there. So as they harvest beans, they're right back in the field with the corn planter. And so it's a pretty important time weather-wise up in that part of the world as well. So overall, when you look at the big picture of South America, this is a combination of corn and soybean production in Brazil and Argentina. And corn acres were down 2 million this year between the two countries, but they are expected to have a record production. So Brazil's going to make up, more than make up for what Argentina loses, and they're going to raise a crop roughly 7 billion bushels of corn. On the soybean side, they raised 5 million more acres combined, and again, Brazil's going to expected to more than make up for the Argentine losses, and expected to have a crop close to 7 billion bushels of beans as well. So we'll see how it finishes, but at the moment, we're looking at some pretty good crops in that part of the world. Now, here's a snapshot of what these funds have just done in the bean market. And you look at the last several years, but go back to last summer, funds were along about 90,000 contracts. In fall, they limited that down to about 60,000. But since then, they've been pretty steady buyers in beans. And when we look at the chart, you'll see that, you know, they've been really responsible for this uptick we've had in the bean market over the last 3 or 4 months. In fact, as of a week ago Friday, they were holding a record long position in soybeans. And, you know, really the two reasons behind that were export demand as well as the drought in Argentina. And so that's gotten them to buy a lot of beans, over 100,000 contracts from the low. Now think about it this way, if you're a hedge fund trader, and every Friday afternoon we get this report that comes out and tells us where their position is. And if you get that report on a Friday and it tells you you and everybody like you is holding a record long position in something, what's your inclination to do? Probably to get out of some of it. You know, probably I don't want to be on the same side of the boat as everybody is. Maybe I want to step over here a little bit. So a week ago, we kind of saw that. We saw some selling in the bean market. Most of that was just people liquidating just to kind of even things out a little bit, maybe take some of that money somewhere else. So the funds did lighten up some of their position last week, but still, you know, for this time of the year, holding near record long position in the soybean market. So that does make beans a little bit vulnerable. If these people decide to come in and liquidate, then they could take the market down. But you look at the 15-year history of bean prices, you know, we're still 15.34 this morning on the spot contract. Still in the upper third, 25% of where prices have been over the last 15 years. I don't know if anybody remembers this. I don't. But we had a COVID low of $8. I don't remember getting that low, but it wasn't that long ago. Less than 3 years ago, we traded beans down to $8. So the fact that we're sitting at 15.34 this morning should make us feel fairly good about our opportunities still to make money in soybeans. And if you look at the March contract, you know, there's a saying that the trend is your friend, and you know, the trend has really steadily been up over the last several months. We put a summer low in, you know, and also think about this. You know, we traded below $13 back in July. That's when we thought we were going to have a monster bean crop. And what if we would have had a monster bean crop? What if Nebraska, Kansas, those guys would not have had a drought this year? Where would the market be today? You know, I would imagine we would have still continued to slide on this market. Since then, though, things have elevated, and you know, you've taken beans back to just below the summer high. We've gotten back above the 9-day, the red line, the 20-day moving average, the blue line, the gold line is the 50-day moving average. Those are all good indicators. They're all pointing up right now. If I happen to be lucky enough to have an old bean left, I would probably hold tight for a minute and see where this market might go. If we see a change in direction, you know, then certainly that would be my signal to maybe get out. Probably that direction change would be breaking below the gold line, the 15-day or the 50-day moving average. That's at 1488 right now. So I would probably kind of ride this thing and see where it goes. The RSI at 57, the green line, the stochastics, both still pointing higher. So, you know, see where it goes the next several days, and maybe we'll get a few more pennies out of this thing. The corn market. If you look back at the report in January, the blue states again did get bigger. Illinois actually got bigger in corn where we were down on beans. Had a record 214 bushel an acre, up 5.9% from last year. Wisconsin, Minnesota also had record yields this year, as did Virginia and West Virginia, and Idaho. I forgot about Idaho. But overall, the U.S. yield was at 173.3. That was down about 2%. Back in July, we were talking about a 180 yield, USDA was. And so you can see that we definitely took the top off that crop from July through harvest. Now the dark red states, you look at this area out here in the west, Nebraska, Kansas, Oklahoma, Texas. I tell people if you hear a giant sucking sound outside, that's that area trying to suck corn to it. You've got big demand going down to that part of the country. I live down by Jacksonville. We got a 100-car shipper down there. They're just circling 100-car trains going to Texas right now. Have been since harvest, and it doesn't look like that's going to stop anytime soon. We're getting eastern Iowa corn that's going to Nebraska by rail. So there's going to be some, you know, some stuff moving in odd directions this year to satisfy, especially that cattle demand out in that part of the country. So kind of keep an eye on that. But not a lot of corn going to the river, at least at this point in time. When you look at the balance sheet from last month, not only did USDA, they actually bumped the yield slightly from December, but it's still down from where it had been. They took 1.6 million harvested acres out because of abandonment out in those plain states especially. So that was a real adjustment and probably made sense that, a lot of that corn out there was cut early for silage and whatever the case was. So production was down 200 million bushels, but again, USDA made a cut to demand to keep ending stocks at kind of the minimum again, down around 1.2 billion bushels. Now the number we're really looking at is the export number. When the report came out back on January 12th, it was bullish. Everybody, market rallied double digits higher that day. The number that concerns me is this export number right here, 1.925 billion. This is the second straight year where you've seen a big drop in exports. We're expected to be down about 20% this year. Sales right now, year to date, and this is after this morning, when we actually got a good number come out, but we're still 43% below last year. So either A, USDA thinks we're going to see a big jump in corn exports to get to this number, or B, that number's still too high. And so next Wednesday, when we get the February report, going to be looking at this export number closely to see what's the government do to that thing. I still think it's too high. I think that number's probably going to come down at least another 100 million bushels, which would raise ending stocks. So we'll see how the exports continue as we go forward. And as you look, now this is again a couple of weeks back, if you look at this year compared to the 5-year average compared to last year, it kind of stinks looking at it from this perspective. So exports have been really lagging so far. Now, one of the big reasons for it has been China. And you look at what's happening in China this year, their purchases of U.S. corn way down from last year. Been very disappointing. And I can think of 3 reasons for that. Number one has been COVID and the lockdowns that China's had. They have not been running their ports at full capacity. They have been focusing on the stuff they need the most, which is mostly oil seeds. Number 2 would be the price of U.S. corn. We talked about it a minute ago that the demand from Texas, Nebraska, plus the ethanol facilities domestically, you've got a lot of domestic demand for corn, prices rallied, plus you throw in the Mississippi River situation this year with lower barge drafts, smaller tows, price of getting stuff to the Gulf has gone way up. So the price of U.S. corn at the port way up, and it's made us uncompetitive. I did see a report this morning that Brazil had a record export in the month of January, record amount of corn exports. So they're taking advantage of our high price. The third reason is the Ukraine. And back in August, Turkey bartered a deal between Russia and the Ukraine that would allow Ukraine to ship. And it seems like a weird way to fight a war, doesn't it? That we're going to bust each other's chops on the front, but we're not going to bother your export facilities over here. We're going to let you go ahead and load grain and hands off. It's just kind of strange. But Turkey needed stuff out of Ukraine and a traditional buyer. You can see the pie chart over here on the right shows what they've shipped so far. 49% of their shipments have been corn, 34% in yellow has been wheat, the rest of it's been oil seeds and a little bit of barley that they ship out of the Ukraine. And you can see who the trading partners have been. The Ukraine's in gold up here. We got the Black Sea sitting right below, and then right across the sea is Turkey to the south. So certainly Turkey going to be a big buyer from the Ukraine. And across the Mediterranean, you got the North African countries, you got Italy, Spain, all been big buyers from the Ukraine. But the one that really stands out is China. China historically has been a good trading partner with the Ukraine, and do you think there's a chance that China was given a little bit of a nudge to Russia to allow Ukrainian grain to leave the country? I absolutely do. China needs to buy, and so they rather buy U.S. stuff or that's more expensive or buy stuff out of the Ukraine. So I think China was twisted on Russia to allow that to happen as well. So we'll see. This could change tomorrow. But back in, I think, November or December, we had a 120-day extension of that agreement. So I'm not sure when that deadline comes up, but it'll be interesting to see if it gets extended again or what the stance is of the Russians. So here's a snapshot of what's happened, what the funds have done in the corn market. You go back to last summer when we were kind of taking this market down. These funds had taken their net position down to just over 100,000 contracts long. Built that back up to nearly 300,000 in the fall as the yields continue to slip, but with poor export demand, they've been net sellers then after that. Now, again, kind of in no man's land. The last 2 years at this time, they've held record long positions in the corn market. Previous 3 years, you know, they've been significantly less than this. And now here we are about 200,000 contracts, give or take. So again, I think this is maybe one of those transition years that what happens? Which way do we go from here? Is there reason to be record long? Do we need to buy corn acres? I don't think we do with demand kind of stinking on the export side of things. So I don't think there's reason for them to get real long. Do they go back to the short side? I think we got to wait and see if we grow a crop first before that would happen. So here's a snapshot of prices. We're at 685 this morning on nearby corn. You know, the upper 20-25% of where prices have been over the last 15 years. So, you know, again, you think back less than 3 years ago, we had corn down at 301 a bushel. It'd be pretty tough to make money today at 301. So certainly want to benefit from where we're at today. And looking at the March contract, you know, the one thing I guess I had a pennant kind of drawn into this thing. You know, we've been making higher lows, we've been making lower highs. We've kind of crunched this market into a equilibrium type of a trade. All of these moving average lines, the colored lines, have all kind of crunched together, which really tells you that there's no real direction for this market right now. And you know, we've kind of really established a tight trading zone. Today, this morning, we opened higher, and then when I was in Monmouth this morning and I updated the chart, we were up, got here, we were down 4 cents, so I updated it again. And so, you know, we're just kind of bobbing back and forth in that trading range right at the moment. If I've got old crop corn to sell, then I'm probably looking at the upper end of this trading range, up around 680, 690. Get it sold and buy a call option. You know, do a minimum price contract. Maybe you go out to May $7 here a while back, or was it 7? I think it was. It was 7 or 8 cents a bushel. Wasn't very expensive. No, it was a 7.50. I'm sorry, 7.50 call was about 7 or 8 cents. So it keeps you in the market just in case the market goes up. If it doesn't, only cost you 7 or 8 cents. You get your money, get your cash, take advantage of strong basis. The one thing negative about today's trade, stochastics lines have crossed back lower. And that might trigger a little bit of additional selling here over the next several days. So watch the 50-day moving average at the bottom, 664, that gold line. That would be our key support if the market were to trade lower. One plug I do want to make, these orange cards we handed out, these are our 2023 marketing cards. And lists all the different marketing services that we've got available at the top. I do an opening bell phone call every morning. Several of you already get that. It's a 2-minute phone blast on the markets. It comes out about 8:40. And I do a market report email letter at night. Comes out whenever I get a chance to send it. But this is what it looks like when the email comes. If you click on the link and open it up, there's a snapshot of the front page. And one of the things that's, oh, you've got a copy of it there as well.
That's last night's.
All right. So one thing I added back in May this past year was this column called the heat check. It's right here on the front left. And the idea behind the heat check is just at a quick glance, you can see which markets are hot, which ones are not. The hot markets are the ones in red. The hot markets are the ones that if you look at the technical indicators, you've got the RSI up over 60. You've got the stochastics lines usually above 70 or 80, which means that market's probably getting toppy, probably due for a correction back down. Probably going to see some technical selling. The not markets, just the opposite. You've got the RSI down around 30, down here at the blue line. Stochastics down in the 30s or 20s, means the market's oversold. We don't want to sell at those times. We want to sit and wait for better days ahead. If you're buyers for feed, maybe that's the time you want to step in and buy the market. Well, the one I show right here was from December 30th. And on that particular day, if you look back at the chart, you had the RSI nudging up against 60, but you had the stochastics lines well up into the 80s, but starting to turn lower. And so I had corn in the not, or in the hot category. We need to sell it. And we had both March and December corn up in the hot category. You also had soybeans, we had cattle, had rice that's hot. We had the dollar index and natural gas in the not category. And within, you know, a couple of days, the corn market did eventually sell back down a little bit. So when that happens, you know, you can sell it, you can buy puts, but I'm just trying to put that out there to give you an indication of when's the time that we need to be taking advantage of the price. I don't necessarily know what day. I'm not going to try to tell you how many bushels to sell. I just want you to be aware of which markets are the ones we need to be focusing on. And I don't have time every day to put charts on every market. and write about every market. So this gives us a chance to look at a quick glance and see which ones we need to take advantage of. Also on the card, just mentioned we do the Aftermath webinar once a month, the day after the crop report each month. I do a podcast called Kicking Up Dust occasionally. I'm on Twitter every morning. So a lot of different ways we try to get market information out to the folks we work with. We've got a bunch of Board of Trade information on the bottom of the front of the card. Then on the back of the card, we've got all the crop report dates for 2023. The dates that we do our webinars, got holiday, market holidays and trading hours, etc. there. So a lot of good information on the markets for this year. But if you're interested in getting the call or the email and you're not already, take a piece of paper, put your name, phone number, email address, give it to Michelle or one of the ladies, and we'll get you hooked up. So it doesn't cost you anything. Again, we're just trying to get information out to help. So looking ahead to 23. Over the next several days, I'm sure we're going to get more and more private analyst guesstimates on acres for this year. These were the USDA baseline numbers that they put out back in November. And they were estimating at that time corn acres this year at 92 million, up 3.4 million. They had soybean acres down 0.5 million to 87. They had all wheat acres up 1.8 million. Now we have seen since then that they have winter wheat seedings up 3.7. So I'm assuming spring wheat's expected to be down 1.5 to 2 million acres. Cotton acres, they had down 1.7 million. I would not be shocked to see cotton 4 or 5 million acres down from last year. Cotton margins are very negative right now. I had a conversation with a gentleman in North Carolina when I was out there last month, and he told me his break even on cotton was $1.05. Cotton market was around 80 cents at the time. But then he said, what do you think I ought to do as far as the cotton market goes? And I said, I wouldn't grow cotton. I'd grow it on paper this year. It's that cheap. Go buy the board and grow your cotton on a piece of paper, and then go plant soybeans at $14. And that's really what a lot of cotton growers are looking at right now. Does it make sense to even put it in the ground? Do I have alternatives? And I think the answer is yes. You get out into Texas, that dryland area where you've got $9 cash corn right now versus losing money in cotton. I think some of the irrigated ground is going to try to grow corn, but I think some of the dry land is going to go to sorghum this year. Again, take advantage of the feed prices. And we usually see that when we have high feed grain prices in that part of the world. So I would anticipate a big drawback in cotton, big expansion, especially in corn and feed grains. So these are moving targets. We know that 92 is not a set number, 87 is not a set number. In fact, I think that those numbers are maybe starting to come together a little bit by some other analyst estimates. But I went back and did a balance sheet just saying what if. What if we plant 92 million acres of corn this year? And I used a trend yield at 179.6. USDA is using 181 as their trend number. I have a hard time with that. We've never grown 180 before, so I hate to plug in 181. But even at 179.6, production would be around 15.2 billion bushels of corn. I think demand should improve this year, but even with that, you could have stocks over 2 billion bushels at the end of the year, which I think would be very bearish, the corn market. And so if we think 92 million, 91 and a half, if those are real type numbers, I think that's bearish to corn. And so that's why these numbers, these early estimates are going to be pretty important for this corn market, and why we want to take advantage of the prices when we can. Now the flip side is soybeans. At 87 million planted acres with a yield of 52 bushels, we would have a crop a little under 4.5 billion bushels, and that just about matches where I think demand would be. So stocks stay pretty tight, and therefore bean price probably shouldn't go down from where it's at today. So given that scenario right now, we're seeing some shifting, I'm sure. You take some of these fringe acres, I realize most Illinois ground's probably already set, but you get into the Dakotas or the South and the Delta, the Southeast, some of those acres could swing one way or the other. And so I think this, this ratio between bean and corn price is going to make a difference. Availability of corn fertilizer going to make a difference. What the price is. So there's a lot of factors that are still going to swing potentially some of these acreage numbers. But you look back to the fall, we had this ratio down around 2.15 to 1, beans over corn. Now we're out closer to 2.3 to 1. So I would think that the bean number has probably come up a little. I think the corn numbers probably come down a little. But again, we're gonna be getting several estimates, I'm sure, over the next few weeks, and guesses, estimate maybe is a strong word, but guesses as to what's gonna get planted this year. So that'll have an impact on our markets. So looking at prices today, here's D's 23 corn. Had a nice little bump yesterday for the first day of the insurance period, but you can see overall, the trend is still holding downward. We've had lower highs each time the market has tried to move. Long-term moving averages have all, and even the shorter term, just about all of them now are kind of pointing lower right now. So we're bucking the trend, trying to turn this thing back higher. But if you look down at the indicators, the RSI and the stochastics, I had corn, D's 23 corn in the knot zone for several days last week because we were oversold, probably due for correction. And we did make a double bottom on the chart at 583 3/4. Since then, we've come up a little bit. Now we're about 11-12 cents off that low. We got above the 9-day. We got above the 20-day moving average. This morning, we traded right up to the 50-day moving average, this gold line, which we haven't really closed above since back in December. That would be a hell of a target for us, 598. If we can get through that, maybe we can try to extend this thing a little bit. My goal for the last couple, 3 months has been the 200-day moving average, which is that light blue line at 612, or the 100-day at 610, which happens to really coincide right with that downtrend line. So I'm thinking today, 605 to 610, I want to be pretty aggressive getting a lot of corn sold, if you haven't already. Certainly I wish, I'd like to have already had a lot on the books. We've had ample opportunities over $6. I'm thinking 35, 40% hedged above $6. If you know what your cost of production is, you know you can make money here, I think it makes sense to get this locked in. And again, the two biggest factors that are negative right now are the export numbers for old crop corn and the prospective acreage number for this year. And in years where we decrease exports and increase acres, that's not a good combination for price down the road. So we'll see what kind of a crop we have, but I certainly want to get quite a bit sold. RSI is pretty neutral, but stochastics lines are kind of pointing up still, so we'll see where this thing can go. I want to get some offers in. On soybeans, I haven't been as aggressive. I've been in the 10 to 15% range, up around $14, and we've had numerous opportunities to do that over the last several months. But each time we get to 14, we kind of run out of gas. Then here, about 2 weeks ago, the market crashed and burned. And that was really on the Argentine weather forecast changing. And what we really saw happen was that Argentine wet forecast, or wetter forecast, had more of an impact on new crop beans than it did on old crop. The old crop, therefore, you kind of think about it, the old crop market is really representative of domestic usage. And we talked about that strong crush demand domestically. And so March beans, yeah, I think there's an export component built in there too, but it's really a function of what old crop demand is. But the Argentine production is going to make a difference for how many acres we need to have this year. And so is it going to be a bigger crop, smaller crop? What's going to happen there? And I think that's why this market's been gyrating a little bit more. But we did make a low. We've come back up. We filled that little chart gap. We got the 9-day moving average. The red line turned higher. Crossed the 200-day. That was a big hurdle. Now we're kind of stuck at the 20-day moving average here this morning. I'm still thinking probably $13.90 or so. Good place to get beans on the books. I don't know if I want to get crazy wild selling a lot of them yet. I do think we need to add bean acres. And so the market does have some work. I think we've got to get at least 88, 89 million acres of beans planted domestically here this year. And so indicators are all turned higher. So I'd probably put some offers in. We were 13.71 this morning. Again, I think that 13.90 level, probably a good place to catch up if you need to make some sales. So what do you do about high prices? Well, number one, we've talked a lot about it, forward selling. If it makes you nervous to be an aggressive forward seller, maybe you step out and buy some out-of-the-money call options to back your sales. I've talked to several guys that are 50% hedged on corn. One guy told me his hedges were 620 to 660. Now he's considering, what do I do next? And do I use options? What do I do? And I think that makes sense this year. And maybe you have to go way out of the money. And if it makes them cheap enough to buy, if that helps you make the sales, that's great. Get profit locked in. The other thing I'm looking at again are the higher revenue coverages. And how can they help me utilize these higher prices and higher revenue triggers for this year? And so the two additional products we're looking at besides revenue protection are SCO and ECO. These are county level coverage that essentially stacks a band of protection on top of your individual coverage. And they're cheaper than individual coverage. As you get up to the high end of individual protection, up to 85%, gets a little pricey. But SCO, ECO, because they're based on the county and because of their subsidy levels, they're cheaper. And so you kind of get the best of both worlds. You can get a high revenue trigger with a little less money being spent. And so this kind of demonstrates how they work. This is your individual coverage in blue down here. You can buy RP protection all the way up to 85% if you want. The next band on top of that yellow band, is SCO. SCO starts where your individual coverage leaves off. So if I go 80% RP, SCO would start at 80% and goes up to 86%. Now this also says on here, I have to do one or the other. I can't do SCO and ARC. I have to do one or the other. There's a reason. These are both very similar, but ARC is through FSA, SCO is a crop insurance program. They both start at 86%. That's the similarity. They're both based on the county, but we'll talk about differences here in just a minute. The next band up is ECO. ECO starts at 86, goes from 86 to 90, or 86 to 95%. So to me, it really boils down to what are you wanting to use crop insurance for this year? Am I using it just to provide a bushel protection? Am I using it to provide a revenue floor? Am I using it to lock in a profit? Maybe buy enough revenue coverage to cover my costs. Am I using it as a marketing tool? And that's really how I view like the high-end ECO. It's kind of like a put option. If I'm getting 95% of whatever the base price is, and if I assume an average yield in the county, then it really becomes a put that's up 95%, essentially 95% strike price from where our crop insurance price is. So what am I using crop insurance for? What are my objectives? We put together this producer profitability matrix this year, and we've had this out for about 2 weeks. But what I really wanted here is a simple tool, doesn't have a lot of moving parts to it, but I'm really looking at the 3 pieces of putting together a profitable plan this year. Number 1 is your expenses. Put in an expense number up here in the red, and I've got 2 numbers here. Number 1 are your total farm expenses. I'm not going to get into the weeds and try to get anybody to tell me all their breakout expenses. Use a flat number, and then a number for crop insurance. And as we make changes or add or subtract crop insurance, we can change that number. And those numbers are going to be taken out of this. The number 2 is forward sales. What am I going to forward sell? That's in the green. What am I going to get locked in? And then number 3 is crop insurance over here in the black. And so we can put in your yield, put in your county's expected yield, put in the base price, and then look at individual protection, SCO, ECO. How would those impact my plan for this year? The matrix at the bottom shows various yields across the top. And I've got 2 rows. I got the producer yield and the county yield, because those are sometimes a little bit different. And we got the harvest prices on the left-hand side. So the matrix then is showing you over 200 possibilities for income this year, for net income. And I used corn at $1,100 an acre in expenses. I guarantee everybody in the room is different than that number. Some of you may be higher, some may be lower. That's kind of in line maybe with what I don't think the university's even that low. I think they're 1,300 or something like that. But I used 11, so you guys can, poke holes in that if you want. But the green boxes down below represent combinations of yield and price where we're making money. The red boxes and the pink represents where I'm losing money. And so we know that if we have a good year, if you have a 220 bushel corn yield at $6 or above, we know we can make money this year. It also shows me that if yield goes down to 165 and the price goes to $5, then I'm probably going to lose a lot of money this year. And so I want to try to build a plan that's going to hopefully get me a profit no matter what happens. That would be great to be able to do. If you go back 5 years ago, I don't think we could have done it back in 2018. Today, I think we can with prices where they're at. And so we're going to make a few changes to this. Number 1 is I'm adding a 75% revenue protection policy. So put a floor under with a 75 RP policy. In this example, it cost me $5 an acre on enterprise units. Pretty dirt cheap. But you kind of get what you pay for. My worst case scenario, it's not enough to cover my expenses. But my worst case scenario is a loss of $115. So maybe I want to bump that coverage up. Let's bump it up to 80%. At 80%, my cost goes to 11 bucks, it's still pretty cheap. Basically what I'm doing here is taking $11 off of my income. Whenever I didn't need the policy, it cost me 11 bucks. But I've limited my downside now to $55 from $115 earlier. So it cost me an additional 6 bucks, I gained $60 in coverage. That's a good trade. I would do that all day long. Let's maybe go another step. Let's go to 85%, which does run your premium up to 25 bucks. So it does go up a little bit. But now my worst case scenario, even after the premium's taken out, it's a loss of $3 an acre. So I've got myself to almost being able to lock in a profit no matter what happens this year, which is a great position to be in. But maybe there's some other things I can do with SCO and ECO. And so that segues a little bit here to this letter I put out recently on ARC or SCO. We're going to talk about SCO. But again, I mentioned that you can't do SCO and ARC. So you can only do one or the other. So should I look at the ARC program? Well, I think Michelle might have this letter in your packet as well that we had done for Henderson County. This is one I did for Knox, but pretty much the same. The program, and she showed you this chart as well, but when you're thinking about the farm program, just kind of a step back. At the FSA office, you have to elect PLC or ARC. PLC is price loss coverage. PLC pays you when the market year average is below these blue box numbers. You get paid that difference in price times your payment yield at FSA times 85% of your base acres. Well, got news, probably not a hot take, but we're not going to get any PLC money this year. Prices right now are these white box numbers. We're way above the PLC price. $3 above on corn, $6 higher on beans, $3.50 on wheat. Even the rice and peanut guys aren't going to get PLC money this year. Probably pretty ticked off about it because they get money just about every year. And prices are still too high for those crops. So PLC this year, not going to pay. Next year, I'll go tell you 99.99% chance PLC won't pay next year. So it's not a great plan right now. Should I consider then the ARC program? Well, ARC is going to use the red box numbers. 398 corn, 957 beans. Those are the 5-year Olympic average prices. So we take the last 5 years, you throw out the high and the low and average the other three, come up with these numbers. Well, they're not very good yet either. But it's a revenue program, so you take that price times your county's 5-year Olympic average yield times 85% of your base acres. Keep in mind that ARC and PLC pay on base acres, that crop insurance pays on planted acres. But those aren't that great, so should I look at SCO? We talked about SCO as the alternative. SCO uses the crop insurance price, which when I wrote this letter last week, that price was running $5.86. Today it's $5.96. Beans were $13.47. A lot higher than what we're looking at for ARC. And so here was an example that I had run. If you looked at, this was Knox County, but Henderson's probably the same. 386 ARC price times the county yield times 86%, 720 bucks in coverage. SCO is going to be over $1,100. So you're going to have a trigger of almost $400 higher with SCO than you would with the ARC program. So this is where I think your most important decision relative to the farm program is not ARC versus PLC, it's whether or not I'm going to buy SCO. And so therefore, talk to Michelle first. Make sure, do I buy SCO? If you're at 85% RP, maybe I don't mess with SCO for 1 percentage point. But maybe if I'm 80% or 75 RP, then SCO might make sense for you. And if I decide to buy SCO, then I cannot sign up for ARC. So when I go to FSA, I have to sign up for PLC. If I decide not to buy SCO, I'll probably sign up for the ARC program then. I give ARC a 5% chance of paying next year. Maybe there's a chance you have a localized county disaster, rest of the country doesn't, and maybe ARC pays some money. But look at the numbers over here. If ARC is going to trigger a payment with this number, then SCO would have triggered a long, long time ago. So any way you look at it, SCO is much more valuable than the ARC program is. So that's the decision you need to make first. So let's go ahead and say, let's back my revenue coverage on my farm down to 80%, kind of the sweet spot of the subsidy, and add SCO. So now I'm up to an 86% trigger. 80% of that is individual, 6% of that is based on the county. my premium is less than it was at 85%, so I saved a few dollars. And now my worst case scenario on here is a gain of 15 bucks. So as long as my yields on my farm trend with the county, they don't always have to be above or below, but as long as they at least go in the same direction as the county, then I'm looking at a profit no matter what happens this year. It cost me 20 bucks an acre total, and you still see a lot of green, dark green boxes on here. Let's bump that up another notch. Let's add ECO to the mix. Let's add ECO up to 90%. So now, essentially, I've got an 80% individual band, and then 10% of county on top of it. And now, even after the premium's taken out, my worst case scenario is a gain of 54 bucks. Let's go up another notch to 95. If I think that the market's going down this year, maybe I need to utilize ECO at the high level. And so at 95%, it's pretty expensive. That takes me up to $59 in premium in this case. But my worst case scenario went up to 95, even after you take the premium out. So again, what's your objective with crop insurance this year? Is it to take advantage of what the price is now and be able to lock in some good guarantees? Is it being able to lock in a profit no matter what happens? Got one more thing I'm going to do, and if I think prices are going down this year, then I need to sell some corn. And so in this example, I sold 100 bushel an acre with an average price of $6. And which is a little, about 45% of what my APH is. And now you can look at all the green on the screen. So my worst case scenario is if the price doesn't change, it stays at $6. If it goes up, I still got 55% I didn't sell. If it goes down, I'm glad I sold 45%. Plus ECO is probably going to pay me some money back as well. And so as the market goes down, I actually end up making more money. So if you don't think we're going to sit at $6, if you think it's a pretty good chance we're going either down if we got a big crop or up if we have a drought, then this is a scenario that really works, even after you pay the premium on the insurance. Next year, if we're at $4.50 corn or $5 at this time of the year, you know, we're going to be scratching our heads a little bit more to figure out what we can do. This year, I think we've got some good opportunities, even with higher input costs, to be able to lock in some profit. So that's why I think it's important to look at this program. I don't think you need to look at 8 different scenarios like I showed you here. Narrow it down to 2 or 3 and see, does it make sense for me to, A, forward sell a bunch of corn right now, B, maybe add SCO and ECO to my coverage this year to get that up to a certain level. Also, within our quoting software, I can go out to this historical tab and go back over, I did this over the last 20 years to see where SCO and ECO would have paid. A lot of people aren't sure, you know, how would the county policies have worked? We didn't have these policies until about 5 years ago. But this shows you back over the last 20 years, which years there would have been payments. And even in, 19, 20, and 21, this is Knox County again, but there would have been some ECO payments. SCO paid back in 12, 13, 14. Those were years, especially 13, 14, where we had some big price drops. Kind of like we think might happen this year. So one other product we've got, if you're a forward marketer and you like to aggressively forward sell, we've got this product called Forward Contract Insurance Protection. FCIP basically is a separate little insurance policy that's going to protect your sales at the elevator. If something happens to where you can't deliver a contract because you didn't raise the bushels, FCIP pays the cost to cancel it. We can cover between 50 and 70% of your APH. This is really made for somebody who wants to aggressively forward sell. The hot spot on there is 50 to 60%. But if I want to go out and sell half my crop next year or 60%, but maybe I'm nervous, what happens if we have prevent plant? What happens if we have a derecho storm blow through, knock out a whole bunch of crop, and I can't deliver the bushels to the elevator? This is going to pay the cancellation. And of course, the reason I would want to consider this year is where prices are. You know, you got nearly $6 futures, you got close to $14 beans. We've got some really good opportunities from a marketing standpoint. So if this fits into your plan for this year, take a look at it. Michelle.
And I will say, a few of you do carry that product, and it is not that expensive. I just got done doing one in Warren County, both in Warren County?
Yeah, both in Warren.
Yeah, for 60%, I think it was $1.44, and it depends on your APH. It's, you know, something you want to look at. The sooner you look at it, we've got to get you signed up though.
The reality is, if you're going to do this every year, you should do it like in the fall for the following year.
Yeah.
Get it in place so that when you start making sales, those sales get included. It will include any sales you've made the prior 30 days, but if you sold grain back in November for next year, those contracts can't get included. So this is something that, I would really want to look at every year that prices are up, that I know I'm going to be an aggressive forward marketer. And do it quicker than usual. Do it today if you're going to do it, even if you're not making your crop insurance election until next month. Now's, you want to get this in place. So, to be able to use it and get the coverage from it. This gentleman up in Minnesota said this. He said, using your revenue protection indemnity payment to settle with the elevator is not the way to make money in farming. This will be the factor that gives you the confidence to make those early season cash sales. And, he's really right. You don't want to have to use your revenue insurance guarantee to pay back the elevator. That money you've kind of got designated to pay, your input costs. If you do have another 2012, I want to cover my input costs, cover my cost of living. Then this FCIP, that'll take care of my sales at the elevator. So like Michelle said, pretty cheap. Again, just a marketing tool. Seldom has it ever been used in the 5 years we've had it. This is the first year that we had anybody actually turn in a claim. We had some areas in Minnesota that were prevented plant this year, couldn't get all the bushels, couldn't get all the acres planted. Guys had had a lot sold already and ended up triggering some losses. But you hope you don't use it, but if you need it, it's there. So bottom line right now, U.S. markets really focused on demand, especially export demand. We'll see if USDA makes changes to its numbers next week. South American weather, still a huge factor. What's going to happen in Argentina? What are those crops looking like? CONAB is the government agency in Brazil. They've got their monthly report out next Thursday, the 9th. So we'll get a lot of numbers next week. Besides South America, China, Ukraine, all of those areas remain very important to the market. Is a U.S. acreage battle ready to get started? I don't know if we need to have a battle. I do think that the bean market needs to add acres relative to what USDA was talking earlier. I know we're going to see a big shift away from cotton. I know we're going to see a shift away from spring wheat up in the Dakotas. So where will those acres go? Lastly, macro markets make a big difference. What happens to the dollar? What happens to the stock market as far as investment money? What happens to interest rates? Yesterday the Fed came out with its announcement, bumped rates a quarter point. Today the Bank of England came out, bumped a half point. What does that do to not only your input costs, but what does it do for investors? All of a sudden you bump rates a half a point or a quarter point. If we do it again in March, where does the investment money start to go? Do they start to get tired of commodities? Maybe shift a little money into interest, into bonds and such. So, that'll be something to look at. And then lastly, black swans. What are the black swans that we're looking at for this year, potentially? Well, if I knew, it wouldn't be a black swan. But the one event that really scares me potentially is Taiwan still. What if China decides it's time to make a move on Taiwan? What happens to our markets if that happens? Do we all of a sudden just say we're not going to trade with China? If that happens, where's the bean market go? The positive potential black swan still is Ukraine. What are they going to get planted this year? I saw their ag minister came out yesterday, and they're estimating production down 3% this year. I wouldn't be shocked if they're down 20% this year. Do they have fuel? Do they have fertilizer? Do they have enough land that doesn't have dead tanks sitting in it to be able to, plant? What is the situation there? Is there still an export market? Can they get it to the port? All of that stuff comes into play. So that's going to be a potential black swan. Does Putin decide tomorrow that he's going to, start lobbing missiles at the export elevators? So if that happens, wheat, corn probably go up. So those will be some potential things to watch. We are setting the base prices for crop insurance right now. Next Wednesday is USDA's February report. Thursday, we'll have our Aftermath webinar, talk all about it. If you don't want to sit at your desk on a Thursday morning at 9 o'clock to listen to it, you can go to YouTube anytime, type in NAU Country. You can watch any of the previous Aftermath webinars that we recorded. This week in February, the 3rd week, and I don't know the exact dates, but we usually have two big things happen that week. Number one is FAPRI, who is the Food and Ag Policy Research Institute. FAPRI gets together in D.C. and they have their unveiling of their 10-year baseline projections for all crops. So they predict what they think is going to happen for supply and demand over the next 10 years. Most of us At the end of the day, we really don't care about years 2 through 10. That stuff's gonna change on its own over time, but most of us are curious what they're thinking for this year. And so that'll be the government's next acreage number that they put out. So we'll be looking at that. Also, usually it's Friday afternoon about 5 o'clock, but the Illinois State NAS office puts out its state report for 22 with the final county yields for last year. And so if you bought ECO, SCO, margin protection, RPI, any of these county policies, we might be interested to see what they had to say. Now, these are not the yields that we use for crop insurance. Crop insurance now uses your physical data that you give to Michelle. That all gets in the system by the end of April, which means we don't get their yields until late spring. But at least these NAS numbers will give us some idea, maybe within 2 to 3 bushels, of where the actual county yields were. Just to give us a guess of whether or not there might be some payments. And then lastly, March 15, that's our big deadline date. So you got about 43 days or so until that happens. So got a few weeks to make some decisions. Any questions or comments? How many people think we're setting the base price right now for crop insurance? How many think the October price will be lower on corn and beans? Raise your hand. How many people think it's going to be higher in October? We got a strong maybe. Well, we'll see what happens. But you know, again, this is why we buy insurance. It's why we hedge. We just have unknowns, and you know, we've got opportunities at $6 corn and $13.75 beans that you know, we don't see every year. So, if you're interested in the call or the email, also don't forget to sign up. Piece of paper, put your name, email, phone number.
Also, the aftermath, Andrew was just talking to me, I think going forward, we'll also like link up, if you know you miss it, then we'll link it up on our website.
Okay.
So that's another way you can watch it also.
All right.
Well, thank you.
Any questions?